Hey, welcome back. In today's episode, I'm going to clarify for you what is a CBDC, a central bank digital currency, and stablecoins, because I think there's some confusion between the two. So really, according to this article, these are the two major forms of digital money, not to be confused, mind you, with digital capital, which for me, that is ultimately what a store of value function provides. So how you can actually protect your wealth and help you to grow it in the long term. That is not what I'm talking about here is digital money. Digital money in this context is used as a medium of exchange. So treat it as a cryptocurrency to manage your day-to-day expenses rather than using it as a vehicle, financial vehicle for growing your wealth. For that, we use Bitcoin as the ultimate leading store of value technology. Digital money are CBDCs and stablecoins as a medium of exchange type currency versus Bitcoin as a store of value. Now, in this article, it gives you the breakdown as to what is a CBDC and what are stablecoins as the two leading forms of digital money. There are opposing visions for finance, being a centralized control, which is what CBDCs pretend to be, versus stablecoins, which is under the auspices of decentralization, not controlled by any central authority. I have my own personal view about that because it's not truly decentralized. So I'll talk more about what I mean by that precisely. So what is a CBDC? What is a central bank digital currency? How does it differ from crypto? CBDCs, they are none other as a digital form of money issued predominantly by central banks. So we're all used to paper currencies. We have banknotes, whether it's US dollar or euro or pound sterling or yen. These are direct paper or promissory notes issued by central banks to confirm that you hold a certain monetary value at that moment in time. These are predominantly issued by central bank institutions and thereby controlled centrally by the fiat state, by the governments, by the elite, by the collectivist, which is the central bank in this case. So an evolution how money works, but most rely on permissioned systems managed by central authorities. All right, so we're very clear about what is a CBDC. It's none other than a digital form of a fiat currency issued and controlled centrally by the central bank. So why governments are exploring CBDCs? That supporters say CBDCs could improve payment efficiency, cut transaction costs, and promote financial inclusion. Emerging markets are especially interested. According to the IMF, the International Monetary Fund, about 60% of central banks in low and middle income countries cite financial inclusion as one of their top reasons for pursuing them in the first place. As cash becomes less viable in an increasingly digital world, that is their argument, CBDCs could offer a bridge for unbanked communities to access digital financial services. But theory isn't reality yet. Most countries remain in pilot phases. Whether CBDCs actually close inclusion gaps or reinforce existing power structures depends entirely on how they're designed and governed. Why CBDCs fall short? Well, they are not decentralized. As we just talked about, it's run by the central banks, right? They are programmable, meaning that governments are capable of enforcing strict parameters on how they are actually used. They could impose spending limits or even blacklist certain transactions. CBDC critics warn of too much surveillance and overreach, especially in countries that don't have strong privacy protections. This is the key point, because the last thing that we need is another way for governments to further superimpose their surveillance on us citizens. We've got enough of the CCTV cameras out on the high street spying on where we shop, how we roam around the high street, and the last thing that we need is to have now CBDCs, another surveillance tactic by the nanny state, looking into our spending patterns, where we shop, when we shop, how we shop, and so on. So this is really where the CBDCs fall short. It's just another surveillance tactic for governments to continue to invade our privacy, which is really the main reason why we are seeing, in fact, CBDCs being abandoned or actually being pulled out. So I would expect CBDCs to fail in the majority of the countries, because there's only, I think, 3 or 4 or 5 countries out there who have actually legitimized the use of CBDCs. And one of the arguments that he mentioned at the very beginning is a false pretense, where they argue that it's mainly to help bridge the gap of the wealthy, the developed nations, and the unwealthy in the emerging nations. So it's really a fallacy and a lie, because stablecoins, they pretty much provide those same arguments. It really does help serve the unbanked and debanked pockets of population around the world. Now let's touch on next, what is a stablecoin? Now, stablecoins are digital assets designed to maintain a steady value, usually by being pegged to a fiat currency like the US dollar. Unlike the CBDCs, they aren't issued by governments. Instead, they are created by private companies or decentralized protocols, and anyone with a crypto wallet can use them. No bank account or permission is required. Some stablecoins are backed by one-to-one by fiat reserves, unlike USDC and USC. Others are backed by crypto collateral like DAI. Some are even backed by physical assets like gold, such as Pax Gold, and few use a hybrid algorithmic models like Frax. This is actually quite unique in the sense that it is not pegged to any physical asset that we are aware of. It is actually controlled by smart contracts and algorithms, which actually determine how it is pegged to the actual target asset. So the example of that is Frax. So really, I don't agree. It's true that the fiat collateralized stablecoins or the commodity-backed stablecoins, they are not issued by the government, but nevertheless, they are issued by private issuers. So in the case of fiat collateralized stablecoins like USDT, that is issued by Tether, that is a private issuer of that particular fiat collateralized stablecoin. But in order to achieve the one-to-one ratio, it has to be backed by a physical currency. In this case, Tether is backed one-to-one with the actual US dollar. And who issues the US dollar? The central banks. So it's actually inaccurate where they say that is not issued by the government. And the same is also the case with commodity-backed stablecoins like PaxG. Again, PaxG is controlled by the private issuer of the PaxG stablecoin. But again, the one-to-one ratio pegged to the actual physical gold is controlled by the central banks, by the fiat central institutions. What I'm trying to say is that they both face the same counterparty risk, which is the central institutions. That is, for me, where people are kind of lost. Stablecoins and CBDCs, they still face the same underlying problem, which is centralized control by fiat institutions. The only advantage, as it explains here, between CBDCs and stablecoins is that stablecoins provide a more global access to cross-border payments seamlessly and are instantaneously settled on the blockchain. It is true that it's decentralized, but for the reason I've just mentioned earlier on, it's not truly decentralized because the underlying fiat currency to which the USDT Tether is pegged to the US dollar is controlled and issued by the Fed, by the central bank. So it's not truly decentralized in that sense, which is all the more reason why I suggest investors to use stablecoins as a medium of exchange currency and not to be confused with as a store of value. For that, ultimately, I use Bitcoin because that is the only truly decentralized truth network that exists today. Not stablecoins, because they serve an entirely different purpose. And in fact, that's how the broader crypto industry are treating cryptocurrencies as a form of medium of exchange and Bitcoin as a store of value. So that is all that I want to leave you today. Hopefully it gives you that clarity as to what is the CBDCs, what are stablecoins, and how they both still relate to the underlying problem in that they are still controlled by the fiat institutions, by the central banks, even though in the case of stablecoins they are managed by private issuers on chain, on the blockchain. They are still pegged to the underlying fiat currency, which is ultimately issued by the government, by the central banks. Whereas Bitcoin, that is a store of value. That is the only truly decentralized network blockchain system that exists out there today. So if you enjoyed incidentally today's episode, don't forget to hit the like button, to share the video to colleagues and friends, and if you haven't done so already, please subscribe to my channel, as I regularly publish some interesting videos such as these, anything to do with Bitcoin, blockchain technology, and the future of finance. So till next time.